Hello and welcome to the Monday Futures Market Outlook for September 12th, 2011. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eMoneySource.com trading room, 5-day complimentary memberships are available. As always, we're going to start out with a weekly chart of the S&P 500 going back 3 decades. When we plot an 80-week moving average on there, it does a very good job to depict the bull and bear market cycles the market has gone through. We bearishly crossed below that over the last 2 months, which in the past has indicated the beginning of some form of a bear market or economic recession. We anticipate that at some stage the market will probably even have a multi-month bounce, but we could end up spending a prolonged period like a year trading below this 80-week moving average, maybe down to the 1,000 level on the S&P. But we'll look at the daily charts here to see where we're going on the short term. Just to make some key intermarket observations, the last 2 months have dynamically changed the landscape of the markets. We've now, like I was showing there on that chart, crossed below that 80-week moving average, and that has indicated bear markets in the past, but this is now also being accompanied by now a strong U.S. dollar, particularly driven by that weak euro and the concerns about Greece. This will continue to damper the commodity markets, and in all our forecasting we will be focusing on the weakening of commodity prices during this cycle as well. The 30-year Treasury bond, as there's concerns about global economic slowdown, we will continue to see a flattening of the yield curve, which will particularly push that 30-year Treasury bond and the 10-year Treasury bonds higher, even to those historic highs as we go over the next few months. When we take a look at that S&P 500 on the daily charts, over the last month, we were focusing on one particular event happening, was that there would be a retracement higher, creating a wedging formation that would push higher and find some sort of short-term highs up in this 1200 to 1250 area on the upside along one of those focal points. Really at that juncture we would be looking for that market to break down, and it's been playing out to the T like we've been forecasting. And at this stage it's very likely that we're going to have a direct retest of the trading lows somewhere in the 1080 to 1100 area over the probably even this week, if not even later today, and we'll retest those zones on the downside. As we retest those zones, that's where the market will determine whether or not this is just going to be a retest of the low or whether there needs to be a measured move lower. So there is always a chance that we're going to see a double bottom and maybe even a short-term trading bottom right along this zone. But if we go for a measured move, we can not only see the 1,000 to 1,020 level focal point down below, but there is even a move that measures as low as 950. We at this stage are going to give the bulls the benefit of the doubt that they're going to hold the 1100 line, but if don't stand in its way if the market really starts accelerating on the downside. Next year, I want to take a look at that U.S. dollar index future, and we drew on that 76, 76.50 focal point up above. We've been looking for that to create some overhead resistance last week, but really the market just blew right through that. We were at least looking for some sort of a market break before it actually made that move. We're now really above there, just like that chart is drawn on there, but we just have to look at it from a little bit of a higher level. At some stage, the euro being so extremely oversold, we will get a little bit of a relief bounce at some stage, probably even starts this week, but really we anticipate that beyond a small short-term consolidation, this market can very easily the US dollar can easily continue to push 78, 79, even 80 on the upside over the next few weeks. Next year, I want to take a look at copper futures, and copper is slowly rolling over. It's the same kind of rising wedge formation that we saw in the S&P, coming up into the retracement zones and now rolling over. Really at this stage, we'll be watching, depending on how strong that US dollar is, whether copper will simply retest the lows around that 380, 390, or finish a measured move that could go as low as 350 to 370 on the downside, and that would be roughly where the lows came in November. So we'll be watching the degree of weakness, but we certainly are anticipating this week to bring in some short-term weakness in copper. Next year, when we take a look at gold futures, gold continues to fight up along this 1900 level on the upside as overhead resistance. We're trying to determine whether this marks a double top along the upside or whether it's just still a little market break before the push goes up into even as high as the 2000 level on the upside. Whether gold first makes a move up to 2000 and then reverses one way or another, we in the bigger picture believe that this move on gold is very mature. And an extended period of consolidation is upon us. And even if there are short-term attempts to break out to higher highs, we think it will be distributed into. Overall, we probably will see gold consolidate more sideways to rather than downwards. I think that there's even a better than 50% chance that gold maintains itself above 1700 even over an extended consolidation. But if we do begin a deep wedging formation on the downside, we could theoretically see testing as low as 1600. But in the first wave, we'll be just looking for a test maybe down to around the 1700 level. Next year, I want to take a look at crude oil, and just like in the broader markets, crude oil has been creating this rising wedge formation, and we're looking for crude oil to weaken, particularly as the U.S. dollar remains strong. It's quite possible here that crude oil makes a break of this wedge to retest that 78.80 level. If there is really a good catalyst for a breakdown in crude oil, we could theoretically see even a low as low as the 65 to 70 level on the downside. But our first inclination is that it will just come down for a retest of that 78.80. So really on all the markets, I'd have a sense of bearishness on them, but I really don't know whether there's going to be enough momentum on the downside to really finish full leg measured moves lower. So we'll be looking for just solid retesting of lows to kind of bang out some short-term bottoms over the next few weeks going into end of September. Finally, I want to look at that 30-year Treasury bond, and you can see as we are edging higher in an attempt to break out above this 40-42 zone, 140-142 zone on the upside. Really, if we can get a nice quick push, we could have a blow-off top, a rush off to this 145 to even 150 area on the upside. As we approach those zones on the upside, that could be where we come up with a short-term or even an intermediate high on bonds as we get into those zones. So right now have a short-term bias for Treasury bonds to go higher, but to recognize that we're probably going to put in some sort of a key high over the next few weeks. That was your Monday Futures Market Outlook. Thank you for joining me.